Technical analysis is the study and investigation of the market's behavior using charts. Trading systems enable traders to analyze the market using various types of charts. Chart analysis requires the development of visual skills. To develop these skills, let's first learn about the three most common types of graphs. A line chart is the most simple and basic of the three types of charts. It is created by connecting various price units over a given time period. Each point only represents the closing price. The line connecting all the points creates a chart that helps to identify trading trends as well as support and resistance levels. Technical analysis usually requires more specific information than that provided by a line chart, so this chart is less appropriate for in-depth analysis. A bar chart includes lines that present different price levels over a given time frame distributed on a graphical diagram. These lines denote the following information. High price. This is the high point of the bar, representing the maximum bullish power for that bar. Opening price. Displayed to the left of the bar's body, representing the price when the bar opened. A bar's opening price is usually identical to the closing price of the preceding bar. Closing price reveals the results of the fight between the bulls and the bears over the course of that bar. The closer the closing price is to the high price, the stronger the bull's victory over the bears over the course of that bar. Low price, the low point of the bar, representing the strongest point the bears reached over the course of that bar. The distance between a bar's high and low points signifies the intensity of the battle between the bulls and the bears. A short bar indicates a calm, quiet market, whereas a long bar signifies a volatile, stormy market. The Japanese candlesticks chart is similar to the bar chart in that it also represents the closing, opening, high and low points for that bar, but using a different display which helps identify various trading patterns. The difference between the charts is that in the Japanese candlesticks chart, the closing and opening prices are enclosed in a rectangle. The use of different colors illustrates the increase or decrease in price over the course of the bar. This is the most common type of chart. First, let's explain what a trend is. Well, a trend is a combination of waves that create the market's direction. Trends do not move in a linear downwards or upwards direction. Rather, they are hidden between the lines of the chart, requiring us to identify them on our own. There are three possible directions a chart can move in: up, down, and sideways. We identify a trend using peaks and troughs. Uptrend. An asset in an uptrend creates a series of increasingly higher peaks and troughs. Downtrend. An asset in a downtrend creates a series of increasingly lower troughs and peaks. Ranging trend. An asset in a ranging trend creates a series of peaks and troughs at price levels that are more or less identical. It's important to remember that when creating the trend line, we can also use the slope of the trend to determine the trend's strength. The steeper the slope is, the stronger the trend. The foundation of technical analysis rests on identifying support and resistance levels. Support and resistance are like a floor and ceiling that restrict the price movement from above and below. A support level is a price level at which the asset tends to stop moving downwards and then reverses direction and starts moving back up. The support level is represented in the diagram by a horizontal or near horizontal line that connects several troughs. The more troughs on the same price level, the stronger the support level. Usually, when a breakout of a strong support level occurs, the trend reversal can be expected, with the price continuing to move in the direction of the new trend. A resistance level is a price level at which the asset tends to stop moving upwards and then reverses direction and starts moving back down. The resistance level is represented in the diagram by a horizontal or near horizontal line that connects several peaks. The more peaks on the same price level, the stronger the resistance level. The stronger the resistance level, the stronger the breakout will likely be when the price eventually does break through the resistance line. The start of a breakout is an excellent point to enter a trade. Until now, you've learned the theoretical foundations of trading. In this chapter, we'll start covering the practical aspects of trading. I'll introduce you to the different types of analysis, and you'll learn to analyze charts, which represents the market's movements. In order to decide where to invest and how much, you must understand the market and try to figure out the direction it will take in the future. Come and learn about the various techniques used to analyze the market.